You see them on the side of the highway, in your neighborhood. Those extra space storage buildings are everywhere. But have you ever stopped to think, is there a serious investment hiding in plain sight? Well, today we're digging into a deep dive analysis to find out exactly that. So that's really the big question we're tackling, isn't it? Could this totally normal, everyday business actually be a secret wealth builder? Let's find out. All right, first things first, we need to get a handle on what this company actually does. What is the business of extra space storage? The business model is actually beautifully simple. At its core, they're basically landlords for our stuff. Think about it. People need storage when life gets complicated. Moving, downsizing, you name it. And that creates this really steady, reliable demand. It's a business built on life's transitions, which makes it surprisingly resilient. Okay, so now we get to the heart of the matter. This analysis is all about figuring out the company's intrinsic value. What is this business truly worth? And that brings up this absolutely crucial concept, intrinsic value. Just think of it as the real, fundamental value of the company, based on how much cash it's expected to make in the future. It's totally separate from the day-to-day noise of its stock price. This is the compass for the entire analysis. And here's the magic number. After crunching all the data, looking at the cash flows, the growth prospects, the whole shebang, the analysis puts the intrinsic value of one share of Extra Space Storage at $132. And this is where it gets really, really interesting. You've got the calculated value on one side at $132, and on the other, the recent market price is $292. That is a massive gap, a huge disconnect. And for an investor, that's a major red flag that the stock might be way, way overvalued right now. So how on earth did the analyst get to that number? To understand the logic, we've got to pop the hood and take a look at the company's financial engine. So the analysis says Extra Space has what's called a moderate competitive moat. I mean, sure, they're big and people recognize the name, but at the end of the day, a storage unit is pretty much a storage unit. It's not that hard for a competitor to build one right across the street. Now let's talk about the good stuff, because there's plenty of it. The company's track record is pretty solid. We're talking impressive revenue growth, fantastic gross margins, over 70%, and it's a cash machine, generating a ton of free cash flow, more than enough to pay its dividends. But, and this is a big but, there are some definite red flags. The return on invested capital, or ROIC, is a really key number. It tells you how good a company is at turning money into more money. And at just 3.4%, it's pretty weak. It suggests they're not getting a great bang for their buck. And a lot of their growth has come from printing and selling new stock. And that brings us to this number. The total number of shares has jumped by almost 58% in just 5 years. So what does that mean for an existing shareholder? Well, think of it like a pizza. It means the company keeps cutting the pie into more and more slices. So even if the pizza gets bigger, your individual slice gets smaller. That's dilution. Okay, so with that whole financial picture in mind, the good, the bad, and the ugly, let's look to the future. What are the biggest risks and opportunities on the horizon for Extra Space Storage? So, this analysis uses a classic SWOT framework. That's strengths, weaknesses, opportunities, and threats to get the full 360-degree view. And that final score, 6.3 out of 10, it basically tells us this is a sold company, for sure, but it's not a slam dunk. It has real challenges to deal with. Now let's play out a few what-if scenarios. In the pessimistic view, the bear case, let's say growth really slows down. Well, in that world, the intrinsic value could drop to about $105 a share. The base case is what the analyst thinks is most likely to happen. And this scenario lands us right back where we started, at that intrinsic value of $132. This assumes things just kind of keep chugging along as they are. All right, but what if everything goes perfectly? What if they hit it out of the park? Well, even in the best-case bull scenario, the analysis puts the value at $155. And here's the key. Even the most optimistic number is still miles away from that current market price of $292. So this brings us to the really practical part of this whole thing. We've got all these numbers, so what do you do with them? What's the right price to actually pay for this stock? See, the analyst who wrote this source is very clear about their goal. They want to earn an average of 9% a year for the next 16 years. And having a specific target like that is what lets you calculate a disciplined buy price. And this table just lays it all out, clear as day. If you want to hit that 9% annual return, the math says you need to buy in at around $110. That builds in what investors call a margin of safety. It's like a financial cushion, just in case things don't go exactly as planned.
So, after this whole deep dive, after looking at everything, what's the bottom line? What's the final verdict here?
The final conclusion is pretty straightforward. Extra space storage seems to be a good, solid company. But at today's price, it's just too expensive if you're aiming for that 9% return. The advice is simple. Be patient. Wait for a much better price.
And really, that leaves us with the big idea. This whole analysis isn't just about one company. It's about having the discipline to match the price you pay to the goals you've set. So the question you have to ask yourself isn't just, is this a good company? It's, what's the right price for my long-term goals? Thanks for joining us.